Hello again. Welcome back to Wade into Wealth. Good looks here today. If you're looking at us on YouTube, we have
got a sign.
We have made this house a home.
That's right.
In that we have a new table, new sign behind us. It's looking good in here. Good in here.
We worked with a company called Image 360, and I have to say the experience with them to do the sign was phenomenal from start to finish.
Very strong. Very strong.
Good.
Excellent customer service.
Yeah.
Would highly recommend for signs if you're looking for something like that, signs or graphics. Check them out. We worked with Deb, and they did an excellent job.
Yeah.
So shout out to Image 360. So today, we're going to talk about something that I think would be really helpful for everyone who's listening to this to give some thought to and consider. Are you a myopic investor? And could that be hurting your long-term returns?
You're right. So what do we mean by that? Essentially, do you check your account every day and make actions based on that? And so what is a myopic investor? I think we'd probably categorize someone who checks their account regularly to the point of every day, multiple times a day, every hour, that without being aware of it, pushes us in the direction of making decisions or viewing outcomes narrowly, making short-term choices rather than adapting the long-term view and constantly evaluating the gains or losses of what one of your investment does. And we want to look and see, does it have, does it open the door for making some mistakes and jeopardizing some of the long-term goals that you may have and making money over a longer time horizon?
Your question is, does it open the door to make mistakes or decisions you might regret over a longer term time horizon? Yeah, absolutely it does.
It does.
Absolutely it does. And I can say there's not a lot in this business you can say with 100% full conviction, but this absolutely does. And we have a bunch of examples to talk about today as to why this happens, contributing factors to it, and then again, ways to distance yourself from this, improve upon it, put yourself in a better position for financial success. I think one of the things that makes it really easy is that we live in an age where so much information is at your fingertips.
Yeah.
And it's literally on your phone. You can log in, you can check your account balances at any point in time that you want.
Password away from always having an updated account value.
Yeah. And I think of it like this. If you think of social media apps are all basically constructed like slot machines. Twitter, Facebook, Instagram, TikTok, any one of these.
You can even go as far as Robinhood.
Right. And I was getting there is that every one of these is predicated on the fact that you're continually looking for the next thing to come up into your view. And there is, I can't think of the word, the chemical in the brain that's released when you're stimulated.
Yep.
And that when that happens, you continue to do it more and more. And when you look at your investments, it's something as simple as you're literally looking to see, did I make money today or did I lose money? And for some of our clients, on any given day, they can look and see your account could be up $50,000.
Yep.
60, we have,
and vice versa,
or down $50,000. And so that's, for a lot of people, that's a year's salary.
Yeah,
that they made, and they can see the value of their investments change in a day. So there is such a draw to it, I think, in some situations that people can get addicted to.
Well, and I think the media feeds into that, specifically when we talk about CNBC. I mean, I was driving home yesterday, and they were talking about a stock. Doesn't even matter what it was, because you can probably insert any name of a stock into this, which is, it was down, I don't know, maybe 15%. And the person on CNBC was, if it goes a little bit lower, I'm going to buy more of it. And it just feeds into the idea of you're gonna just wait. I mean, if you think that it's a good investment, if it goes down 2% more, in the grand scheme of things, if it is a good investment, it's not going to make that big of a deal in the long term. And the media, when I'm saying I'm saying the media specifically on CNBC, they're constantly talking about a trade. If it goes to this, we'll do that. Or if it comes down to this, we'll buy more of it. And That's not how real wealth is built,
No.
but it does provide a great soundbite. And
Yeah.
it does, if you start to kind of go down that rabbit hole, all of a sudden hitting refresh, checking on your phone, swiping down, and checking, oh, I just bought this stock, and I've had it for 3 days, and I'm down 5%, which means this is a bad investment. No, because you haven't given it the time to see. And if you sell it after 3 days, yes, that was a bad investment.
There are studies that have been done where they have literally attached and monitored people's brain waves and brain activity while looking at different outcomes with money. And what has been shown time and time again in every one of these studies is that the emotional reaction to a loss of a certain amount is significantly stronger than the emotional reaction to a gain of a certain amount. So if you look and see, I made $10,000, there will be an emotional reaction to that. But if you were to look and see a loss of $10,000, the emotional reaction to that so much stronger than the gain. And that really is where it plays into decisions and actions that start to be taken that can really have a negative impact.
Well, the pain of a dollar loss is far greater than the pleasure of a dollar made.
Yeah, it is. So, think back to 2020.
Yep.
And I mean, I'm going to share a couple of stories here. I have a couple of clients I know, they only check their balances on like January 1st and June 30th.
Yep. Okay.
They check at the beginning and the halfway point of the year, and they don't look other than that.
Yeah, nothing wrong. Honestly, there's nothing wrong with that.
No, I don't mind that at all. So for those clients, the story that they saw over the course of 2020, this is when March of 2020, the world shut down, et cetera, stock market, S&P 500 drops 35% from mid-February to April. What you saw, if you were looking every day, is you just took punches to the gut every day.
Right.
You took a punch. Every time the Dow was down.
And you probably didn't sleep
points.
well.
No, right. Now, and you knew when the market was down 35%. Now, if you were one of these folks who just logged in to look at their balance at the end of June, you saw that your investments were down, but down maybe 7-8% on the year instead of 35%. And I know this because I've talked to people and said, well, do you remember what happened in March of 2020? And the answer's been no, what happened? And I said, well, that was, COVID. They say, oh, well, what happened to my investments? I said, well, they were down. Right. They didn't experience that. And because of that, the thought never even came into these folks' minds to have emotional reactions or to panic or make decisions. Right. And then when you looked at the end of the year, they saw, oh, we made 10, 11% that year.
That was a great year.
Now, that person's experience and view of that year from a financial perspective is significantly different than someone who's logging in every day and looking at their investments.
Also one with less stress and less anxiety.
Because significantly.
Yeah, right. And so it's one thing for us to talk about this, but we put together a little bit of an example. And in 2021, real estate, specifically real estate investment trusts, REITs, had their best year that they've had in almost 5 decades. The Vanguard Real Estate Investment Trust Index was up more than 40%. As I'd mentioned, best return in almost 50 years.
And that's because the real estate market was off the chains in 2021, and this is an investment vehicle that is tracking that.
Sure. The S&P 500, measure of the 500 leading U.S. companies, 2021 was up 27%. So you look at that, and in this scope, real estate up more than 40% for that particular exchange, that index. S&P 500 leading companies up 27%. Not bad. But the Vanguard Real Estate Index performed about 50% better. Which, taken in that scope, one would look at that, wow, that's a great investment.
Yeah.
And it was for 2021. Let's go back to 2020. In 2020, the S&P 500 up almost 20%. In 2020, that same real estate index down 5%. So if we're looking at it in that window, not so great. Significant underperformance when compared. So let's talk about a dollar. You invest $1 into that specific, or both of them, the real estate investment and the S&P 500. fast forward to the end of this year, if you put it in the real estate investment, even though significant outperformance in 2021, your dollar would be worth $1.33 today. Not bad. Still not bad.
No.
The dollar invested into the S&P 500 would be worth more than $1.50. Now, let's talk about the myopic investor. Because when you're seeing it and we're viewing things in a narrow and short-sighted view, if after the real estate investment has a poor year...
Is the myopic investor going to do something here that may impact their future performance?
I mean, I think that they probably could. You may look at that and say, well, I don't want this investment anymore. It significantly underperforms when compared to just a general market index. So let's say that investor sells the real estate investment and then buys the S&P 500. Their dollar today, assuming they did it on January 1st, their dollar today would be worth $1.20. The worst option of the three.
Mm-hmm.
So it's a very easy, real-life and applicable example where when we have things that are happening and we're watching the market go up and down, as human beings, it is natural to want to have a sense of control. And it's natural to want to take action. However, that short-sighted view, that what some would consider micromanagement on that level, in a lot of ways can have a negative impact for your longer-term returns.
It's not that different than if you're driving a car. You drive and you look out the front windshield. You want to see where you're going.
I would hope that that's what most people are doing.
I would hope. You drive your vehicle and you look out the front because you want to see where you're going. You don't look out the side window.
Or the rear view mirror.
Right.
I mean, you will check
Well,
it.
you don't look to see where you, because if you look out the side, this is exactly where you are at that moment. That is checking your account balance today. It's telling you where you are today.
Yep.
You can't do that, and you can't drive the car looking out the rearview mirror. Now, you do have to occasionally look out the side, and you do have to check your rearview mirror.
Mm-hmm.
You have to keep an eye on those and be cognizant and aware of them from time to time. But what you don't do is drive the car looking out the side of the back. And the reason for that is if you do, you crash.
Yep.
And if you do that with your investments, you increase the potential for your own personal crash of sorts there.
For some reason, that analogy reminded me of the time when Dad was trying to teach you how to drive stick with the white car in Bosie's parking lot in Batavia.
I still don't know how to drive standard.
I don't know why I was forced to go along for that driver's lesson.
It wasn't
sitting in the back. It was just never-ending whiplash of the car slamming forward and stopping abruptly. But that analogy reminded me of that experience.
So Dad and my wife Liz like to commiserate about the times they have each tried to teach me to drive standard, because Liz tried to teach me that in the it was a parking lot over off University Ave, right across from Harris Corp.
Yeah.
And it was not going well.
I know the parking lot.
It was not going well. And all of a sudden, like, there's a knock on the window, and it's a security guard from Harris. Harris is a government contractor, so they have security on their on their premises. And he goes, "What are you guys doing?" She's like, "I'm trying to teach him to drive standard." And he just goes, "Okay," laughed and left. No, it didn't work.
No,
I don't think that's the same, but.
It's not, but I did remember that. So we had to break the.
It's a good memory by all. Good memory had by all.
Yeah, I'm sure.
But what happens when you're looking every day is that you are constantly aware of the ups and downs, and you feel those so much more. And what happens is that there is a human nature is to be more aware of it and feel like you need to take action to be more in control.
And when you say you feel it more, you feel the down. You just feel the down more.
Right, because what would you do if it was making money? You do absolutely nothing.
Oh, you look at it and think, well, that's nice. And then you go about your business. Right. But when it goes down, you look and think, well, what changes do I need to make in order to stop this? Because that's a natural reaction.
Mm-hmm.
That's an emotional reaction. We often talk about Warren Buffett, widely considered to be one of the most successful investors in time. Not the person who's generated the highest consistent returns.
No.
but because he started when he was young. He used time. He wasn't using getting in and out of investments every day, getting out of one, going back into it just because it went down a couple dollars. Mm-hmm. Instead, he focused on quality and time. And that's why for a person who has a net worth north of $100 billion, about 90% of that came after he was in his mid-60s.
Yes.
It didn't
Actually,
happen.
more than 90% came after he turned 60.
It didn't happen overnight. And there's a great statistic for a gentleman, and his name escapes me, but who has generated some of the best consistent returns, the highest, where he's got a compound rate of like more than 60%. But that gentleman, and I can't remember his name, I was reading the article about it, started in his 50s. His net worth is about 20-30% of what Warren Buffett's is. So the key to good investing isn't about the highest return every single year. Because typically when you have those highest returns, it ends up being a one-off scenario that's not a proven, repeatable process. Instead, the best investing is to seek generating good returns consistently over time, and then you're allowing compound interest to basically run free and wild, which is a very, very significant and positive benefit to anyone's long-term returns in generating and building wealth.
Yeah. So what do we do? Because it's easy for us to sit here and say, "Oh, here's what you should do. Here are the benefits. Here are the negatives to that." So what do you do? I will offer a suggestion because I was literally having this conversation with a husband and wife last night who I was meeting with for the first time, and they were asking about investments. They didn't really know a lot about them, how we would operate if the market was, in a crash or period of chaos. And I said, what is going to be most important for you is to not think about your investments in terms of how they are doing at any one given point in time, but to think about what those investments can provide you in the future. And for this husband and wife, it was being able to travel with their children. It was being able to, if they have grandkids along the way, to spend time with them, to have life experiences with them. I said, for you, your investments are simply tools in a toolbox to provide you with time and experiences with your family in nature. What you have just told me is most important to you. If you can look at your investments and shift your perspective, think about why you're doing this. Why are you investing for a certain goal? And that's different for everyone, but think about why. Is it peace of mind? Is it early retirement? Is it time? Is it gifting to your family? Is it paying for a grandchild's college? Whatever it is, define that. And then the next time the market takes a turn downward, and there's going to be a next time, there will be several next times.
Yep.
Ask yourself, why am I doing this? And will what I want to do in this moment in time negatively impact the potential for me to have an experience with my children, with my grandchildren? And the answer to that question probably tells you what action, if any, you should take.
Yes, I agree. Perspective is always great.
Always helps.
Always much easier said than done. And I think if you're someone who falls in the camp of you have a routine of regularly checking your investments every day, consider taking the app off of your phone. Don't input everything into, if you have an iPhone, into the stock screen that's right on there for you to check that. Set a date, set a reminder. Check it once a month if you need to. Check it every 3 months.
Or I want to interject because what I would suggest is not starting with as much of a distance between checking. Because what I think may be difficult sometimes is to go from every day to once a month.
Look at you. Valid point.
What I would suggest is start with 4 days. Maybe it's just 4 days a week. Then you go to 3. Or maybe it's 3 days a week and you don't look 2 days a week. You're going to look on Monday, Wednesday, and Friday, but you don't look on Tuesdays and Thursdays. Start with a smaller amount. Reduce it by 20% or something along those lines so you're not feeling that shock of, I got to look because I want to know what's happening. Mm-hmm. When you see it's okay it was fine on Friday when I didn't look, then you start to not miss it. And the quality of your life actually improves because you're not stressing about it.
That's right.
So, final thoughts? This was a good podcast.
We try. That's our job. No, I think the biggest thing is to consider taking the action on that, because as humans, there's no greater saying when it comes to investing that the pain of a dollar lost is significantly greater than the pleasure of a dollar made. Again, it's easier said than done to know I can't have an emotional reaction, but by making some actionable steps to reducing the amount of time that you spend looking at it and worrying about it, you're going to be happier, you'll be less anxious, and you'll have less stress in your life.
Yeah, and you will significantly reduce the potential to make decisions that you regret in the future.
Right, and I think you would likely see a direct impact to the bottom line and your long-term returns if you give it enough time.
Yeah, absolutely. I think if we ask anyone, hey, if we can give you a strategy to give you the potential for less regret in the future, would you take it? I think it would be hard-pressed to find somebody who would not like that deal.
Sure, yeah.
So we'll end on that note. Enjoy this sign behind us. Looks good. Looks good. I like the way it looks. We've turned this house into a home, and we're glad you're with us. We will return next week. Thanks for being with us on Wade into Wealth.